Hi everyone. So 2024 is a very important year when it comes to politics. There are elections that is going to happen in India, US, UK and a bunch of other countries which are very important from an economics point of view. Now, why am I talking about something that is going to happen 2 years from now? The reason is fairly simple, that the stock markets or economy is intricately linked to political results. And let me show you some data as to how the Indian stock markets have behaved on last 4 occasions when the election results were being announced. So we will track the data 1 year in advance from the election results. So here is the data for 1999 and the markets went up by plus 1791 points when the Sensex used to trade at 4,709. So this is approximately a 40% rise in the stock market. If you look at 2004 election results, the Sensex was at 5,800 and it gained approximately another 40%. 2009 was an anomaly year. Why? Because 2008 financial crisis took place, which literally shook everything. So the stock markets fell, right? And this was a rare occasion. In 2014, again, the stock markets recovered quite aggressively. The last Lok Sabha elections in India happened in 2019. So let us quickly study the market between 2018 and 2019. So here is the data for you, and the election results are mostly announced in May, June time, right? So we can start tracking the data from somewhere here, approximately 10,000 levels, and it went up by approximately 20%. So I hope you get the direction where I'm going, that 2022 has been a horrible year. 2024, we are going to have an election. So is 2023 going to be a massive winner for stock market investors? I'm going to present a macroeconomic analysis and I will back everything that I say with data. Let me know your viewpoint also in the comment box. I will show you both the pro and con side of the equation as to what could potentially happen going in 2023. Do watch the video till the very end because I'm going to help you understand at what point I will start booking profits. I'll give you the specific figure where I'll be booking profits and I'll explain you the rationale why, but I will reveal the answer along the video. So you have to watch the entire video very carefully. So point number 1, we need to understand where we currently are and do we have higher chances of going down from this point, or are the markets going to start recovering very soon? So for this, let us study the data from the Indian market and the US market. So let me first do the analysis for the Indian market. Here I have drawn some important levels. So this shows the 2020 data. What happened in the market crash of 2020? That the Nifty corrected by approximately 38%. Then it started running after that because the government printed a lot of money and it ended up giving a return of approximately 142%. Then what happened? That for the last 1 year, the markets have been in a sideways movement and the market started correcting from November of 2021 and the correction is somewhat still going on. So what's the bottom the markets made in this second round of correction? So the markets fell by approximately 19%. This is a very important figure and I will come back to this why, but please remember the figure 19%. Then since then the markets have recovered a little bit, approximately by 12.5%, and now they are dancing around in the sideways manner and probably they will give a little run up during Diwali. Please don't consider this as a recommendation to buy. I'm simply giving my viewpoint. Now let us do the same analysis for the US market. So here let us understand how Nasdaq Composite is working. So this is the 2020 crash. How much did the markets correct by? So they corrected by approximately 33%, almost similar figure. Then the market started to give a run up. They gave a run up of 143%. Almost very similar to India. And then the markets corrected and they fell by approximately 36%. And therefore, I was showing you that 18% figure, that the Indian markets fell by 18% and after that they have given some kind of recovery. But the US markets have corrected quite aggressively and they have fallen by 36% in this second round of correction, but have not been able to recover. So this leaves us with 2 choices as of now. Choice number 1 is that, you know what, Indian markets are overvalued and they are going to mimic the US markets and are going to fall further from this stage and will reach that 36% overall drop, or the US markets are already oversold and they have been oversold so much that they fell by 36%. And this is probably the best time to buy the US stocks because the US markets can only recover and they will at least recover by what the Indian markets have recovered. So which narrative you should believe in order to understand understand that, you need to understand the GDP game. But before going there, some of you are very keen on investing in US stocks. So for that, you can check Vested. It's a wonderful platform for US stock investing. The link is in the description box and you can use my links and check my US stock portfolio also. There are some stocks that I'm very bullish on in the US, and I have created a Vest which you can find on Vested. The link is in the description box. So now let us move on to understanding the GDP game. So first and foremost, there is a very strong correlation between the GDP of a country and the stock market performance. This could be Sensex in India or Nifty in India. Now the important point to note here is that it's not as if that this game is exactly mimicked. It's not as if that GDP is going like this, then the stock market should also go like this, exactly mirroring it. There will be occasions when GDP will go like this blue dart. And what will happen to Nifty is that it might just display slightly opposite nature there, that when this is going down, Nifty will go up. When this is going up, Nifty will go down. But more or less, it will follow this pattern. This is very, very important aspect to understand. Now you might have a natural question that, hey, why is it that that happens? Is there some logical explanation behind it? Yes, there is a very strong logical explanation. Now think about it this way, that what is GDP and what is GDP made of? GDP is the sum total of goods and services which is produced within the borders of a country. Now ask yourself that who produces this GDP in a country like India? These would be big companies. So which big companies would this be? So these would be companies like ITC, Reliance and all that stuff. So where does this feature in? So this features in Nifty 50. So therefore when the GDP goes like this, more or less the Nifty will also follow suit, and same equation holds true even in the US economy. Now let me do a structural comparison of this particular data point in the US market and the Indian market and help you understand the reason why the Indian markets are not overvalued and why even the US markets are not overvalued. Okay, so let us look at the relationship between GDP and the equities market in India first, and then we will complete that exercise for the US also. So let me look at the period between 2014-15. So this period up until 2020, just before the crash, right? So what you would notice? So you would notice that the GDP here was approximately 2000 and here it is hitting almost 3000, right? So we'll do mota math. So what is it that you observe? So you observe that, hey, the GDP growth in India was roughly 50% from 2014 to approximately 2020. So let us look that did Nifty also follow this range? So for this, we go to 2014 data almost, right? So here 8,000 and all the way here. So this is almost 12,000. So 12,000 minus 8,000, 4,000, 4,000 divided by 8, which gives you again a 50% rise. So this math is actually correct. In fact, I would encourage you to do this exercise on a 4 or 5 year window and you will see this play out up to 80-90% accuracy. Now let us interestingly analyze the US market. Okay, so here is the GDP estimates for the US, and what you will see is that this is like 2014-2015 period. So we were at roughly 17.5 and in 2020, just before the crash, we were at 21K. So what is the math? How much is the percentage increase in GDP for the US? So this would be roughly 24-25%. So this has been the GDP rise. Now let us correlate this data to the market, that how much did the market go up by in this same time frame. So take a look. So this was approximately like 2000 levels and we went up until 20 to 4,000 levels. So what is it that you notice? So you notice that in India, the GDP rise was roughly 50% and the stock market rise was roughly 50%. So this was somewhat correlated. In the US, the GDP increased by roughly 25%, but the stock market rose by 50%. So by 2020, even before the crash, the US stock markets were somewhat overvalued. This is a very, very important point to understand, because one of the data points that I showed you earlier in the video, what was I saying? I was saying that, hey, that Indian markets in this recent crash went down by roughly 18% and they recovered a little bit. But the US markets have fallen by 35-36%, but they have not recovered. Why is that the case? The reason is very simple. The answer actually lies before 2020 itself. And as a result, what people started to talk about was something called as the Buffett Indicator. Now, what is Buffett Indicator and how you can use it and apply it to the US market? I will give you a very quick commentary, and understanding this point is very critical because it will help you make a call whether we are really bottoming out or are we not bottoming out. Bottoming out means that have we formed almost the lowest point and from this point we are going to run upwards or not. So let me very quickly complete the analysis and help you understand about this Buffett Indicator, because this has been frequently talked about in the US market. So let me give you some understanding. So Buffett Indicator's formula is this, and it says that it is the total value of all publicly traded stocks. So in one way, this is the market cap of all the publicly traded companies in the US. And this is divided by the GDP of the country. If we are above 100%, then it indicates that the markets are overvalued. And if we are below 100%, for example, here, this was a range where we were somewhat undervalued. This was why? Because we were below that 100% indicator. So this would indicate that the markets are undervalued. So I hope this concept is clear that what Buffett Indicator actually is. Now, if you actually apply this Buffett Indicator, it becomes like a great talking point in the US market. Why? Because in 2000, the Buffett Indicator was indicating around 133%. Then the crash happened and the market corrected by 50-60%. Same thing happened that, hey, we are above 100 here, approximately 105, 106, and then the markets corrected again. And now we are at an all-time high, approximately 200, and the markets have started to correct quite aggressively. So the natural question comes that right now, this data is pointing to 146.25%. So are we going to go down below 100%? Is that going to happen? Because if that is supposed to be the case, then there's a lot of correction left in the US market. And if the US market corrects further from this point, then it is very unlikely that the Indian markets will stay afloat. It will also correct. So this is open to interpretation, and I will help you understand my version. So here is a video that I had done on excess money printing and how India will win that race. In case you have not watched that video, the link again is in the description box. Please watch it. Super important macroeconomic video. But let me explain one of the key points from that conversation. Now here is the balance sheet of the top 5 central banks. What you would notice is that just before 2008 or around 2008 time, the size of this balance sheet was roughly $4.5 trillion. Then in 2022, the size of this balance sheet is roughly $27 trillion. So approximately $22 trillion of new money has been created. See, there is no problem in terms of creation of new money. That is not an issue at all. The issue is, but at what pace that new money is being created. I hope all of us can agree that this number looks extremely fluffed up, right? $22 trillion when the balance sheet was roughly $4.5 trillion. It's a lot of money that has been added in the last 15-16 years. This is point number one. Now, if so much money has been printed, what does it create impact on? It creates impact on the market cap of the companies. Why market cap? Because this excess money, where it is flowing to? It is flowing to businesses and mostly listed businesses. And what will happen to their market cap? Their market cap is going to go up dramatically. So this is what exactly has happened in the US stock markets. Now, second related point is around the GDP. So here we quickly understood that, hey, that market cap going up has largely happened because of this excess money printing. But GDP is what? GDP is actually a lagging indicator. What needs to happen is that market cap of the companies will go up immediately. For example, 2020 was a classic case that a lot of money printing took place and the stock market went up dramatically very quickly, because it is somewhat of a real-time indicator. It is not a lagging indicator. GDP, on the other hand, is a lagging indicator. For example, let's say that ITC's valuation almost got doubled. Now ITC is theoretically sitting on more valuation, but it will have to put up more factories. It will have to increase the prices of its product proportionally. Then it will generate quarterly results, and then it will translate into higher GDP. So GDP becomes a lagging factor. So what I'm trying to tell you through this story is fairly simple, that this number that you see right now, 146%, according to me, this is actually undervalued. This should be much higher given the rate at which money has been printed from this point on, right? So a lot of money has been printed. Therefore, this ratio or this indicator would not work at 100% baseline now. The baseline would have increased quite dramatically from this point. So now comes the question that what is going to happen next in the year 2023? So the first key thing that is going to happen in the year 2023 is that the investors are going to take more risk. Why is that the case? Because there is something called as risking on period of the economy and risking off period of the economy. Currently, what we have witnessed in the last 1 year was a risking off period of the economy. What it simply means is that because of Russia-Ukraine war, bunch of other negative things that have been going on in the economy, a lot of money flew into safer instruments like bond market. Now, if you're working with the assumption that, hey, that the stock markets have to recover and peak out by 2024 when the elections need to happen, then the stock market recovery should start happening from next year onwards for sure. So this is something that is likely to happen. And if we study the current state of the economy, this is not a risking on period, this is a risking off period, which simply means that a lot of money is going to flow to equities. So what do I see happening from a technical point of view? So what I would say is that this has become a fairly important resistance point. The line has been touched multiple times and the Nifty has fallen. So this is a major resistance point. This gives us an immediate target of roughly 21,000, and this becomes the target price at which I'll be shedding a lot of portfolio, but I can only shed this portfolio if I start buying things now and I'm aggressively buying. In case you want to figure out what items am I buying, I give very quick commentary on everyday basis on YouTube member community, and you could consider that membership. So how much is the total gain that we are looking at if we reach this point? So we are looking at roughly 25-30% gain in the market, which is a very good gain if you are keeping a year and a half viewpoint, and just by swinging Nifty, which is a fairly safe instrument to swing, you can make up to 25% gain in the next 1.5 years. I hope you like this analysis. If you did, do press the like button and I will see you soon.